Hey, what's up, guys? John here. Jerome Powell just increased interest rates again, and I believe that it's getting set up for a massive bank rug pull. That's what I think is going to happen. Regional banks, I think we're going to see a massive bank consolidation unfolding over the next 6 to 12 to 24 months. It's going to be unreal, and I think it's going to change the entire financial system. Now, I'm not saying this to be dramatic, but I was watching a video, this was like 4 or 5 months ago, with the FDIC. They were talking about bank runs and bail-ins, and they were talking about how bad the banking system really is.
People understand they can be bailed in, but you don't want a huge run on the institution. But
I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
I was looking at it, and as I started digging into the balance sheets of these banks, and I'm like, they're right. This is going to be a really, really big mess. I put this video out February 21st, kind of breaking down some of the facts, and 3 weeks later, March 10th, that's exactly what started happening. Signature Bank collapsed, SVB, First Republic started stepping into some really, really big problems, Silvergate. You had all these situations unfolding in the banking system, and you think about it, these banks are sitting on massive losses right now, and every time they hike rates, the losses just start compounding, start getting out of control. And that's, I think, what they realize is going to happen next. We're going to see massive bank failures. I'm going to break it all down for you in this video. It's going to be unreal. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's really going on. And at the end of the video, I'm going to tell you what you should be doing if you have very limited capital right now. You're kind of in a corner. You don't know what to do. I'll break it down for you in a second. So look at this. So Fed raises interest rates 25 basis points, opens door for another hike despite easing inflation. Now, many people would say inflation is easing, but probably more people would say it's not. Everything's getting extremely expensive, and a lot of people don't really trust these numbers. But look at this. Treasury Secretary Yellen says she wouldn't be surprised to see more bank consolidation because she knows there's going to be more bank consolidation. Just yesterday, the PacWest, they basically collapsed and they got acquired by Bank of California in an all-stock transaction. This is kind of just showing us the tip of the iceberg. We're going to start getting bank collapses are going to start becoming more normalized. People aren't even going to think twice about it. It's just going to be something that just happens, and then people forget about it at the end of the day. And then before you know it, they're going to look back inside of 6 months or a year and realize, hey, 100 small banks actually collapsed. That's what's going to happen. Look at this situation here. So PacWest is helping regulators make their case for bolstering U.S. banks, right? And what they said here is that the 2008-2009 financial crisis and that higher requirements could restrict lending. That's what I've been saying is going to happen. I believe that banks nationwide are going to start suffering massive losses on their auto loan portfolios, residential real estate portfolios, specifically commercial real estate as well, business loans. They're going to start taking massive, massive losses. And with these new capital requirements, what are they going to do? They're going to start restricting their lending, and that's how they make money, by lending money out. But they need to restrict lending and only lend money to people that are going to position the bank in a better way by actually paying them back with a smaller amount of interest. With good credit, you end up getting more favorable interest rates. But with lower credit scores, their banks end up charging a hell of a lot more interest, but they take a lot more risk. And in this environment, what banks are going to want to start taking risk, right? So look at this. Fed Chair for Supervisor Mark Barr said earlier this month that the Fed would principally raise capital requirements to the largest, most complex banks, the biggest institutions, will be asked to hold an additional 2 percentage points of capital or an additional $2 of capital for every $100 of risk-weighted assets. Capital is the buffer banks have to hold to absorb future losses. He also said regulators would widen the scope of the new rules to institutions with as few as $100 billion in assets, meaning roughly 30 banks would be subject to them. The combined PacWest and Bank of California would be unable to cap based on their combined assets of $36 billion. So this is what's going to happen. The regional banking, they say investors think that a regional banking crisis was over. What a joke. That was on the 22nd. Just a few days later, another bank collapsed, Bank of California. It's nowhere near over. Don't read the headlines, read between the lines. Look at what's actually happening. Look at the real balance sheets of these banks. Look at where these banks and lending institutions really stand. You'll see a really clear picture. Commercial real estate, I think, is a picture that everyone should pay attention to because it's going to have a huge impact on the economy. So they say it's a $1 trillion wall of worry for commercial real estate that spirals through 2027. But Look at this situation. So yields on commercial mortgage bonds now 11%, near 11%. Big-time landlords have begun surrendering office buildings and other struggling properties to lenders this year, when just a few years ago, they were fetching sky-high values amid super low rates. Many consider it the start of reckoning for the estimated $20.7 trillion commercial real estate market, likely the biggest test of confidence since the 2007-2008 global financial crisis. I believe we're stepping into something way bigger than 2007, 2008. Brian Lane, the Wells Fargo Investment Institute lead analyst for private credit, pointed to a $1 trillion wall of worry as the commercial real estate loans come due through the end of 2024, next year, right? And $2.5 trillion in the next 2.5 years. Absolutely crazy, 3.5 years. Property owners are facing higher vacancies, reduced net operating income, falling prices, rising capitalization rates, while valuations have started to decline in most property types. Now, people don't know what a capitalization rate is. Most people don't that aren't in real estate. It's very simple. What a cap rate is, a capitalization rate, it's simply the net operating income that the building generates. So if you look at a building, you look at all the money that comes in from that building, from rents, that's the gross income. You minus the expenses, that's the net income. You divide the net income, the annual net income, divided by the purchase price will give you a capitalization rate. And so when lenders are lending money on these properties, they look at the capitalization rate. And interest rates play a very, very big role underwriting these loans. And when you have a situation where interest rates are 3% and now they're 7% or 8%, you have a very bad dynamic for landlords and property owners nationwide. A recent McKinsey report pegged prices for office buildings as likely to fall as much as 42%. That is absolutely shocking. So to put this into context, if you bought a $10 million property a couple of years ago when everyone was buying commercial real estate, now that property, if it dropped, let's say 42%, maybe you have, give or take, a $5.5 million asset, right? $6 million asset on a good day. And that property, if you bought it for $10 million and you put $3 million down, you have a $7 million loan. If it's worth $5.5 million, that means you're $1.5 million underwater on the property, right? $1.5 million underwater on the property. That's if your valuation stayed, right? So what are people going to do? They're going to come to the table with $2 million in cash, $2.5 million in cash, just to hold on to the deal. Maybe a little bit more, closer to $3 million, because they're going to want to see that you have equity in the deal. So if it's worth $5.5 million, they're going to say, we'll put a $4 million loan on this property. We'll put a $4 million loan on it. You owe $7 million. So come to the table, give us $3 million. Like, how many people are going to be able to do that? They're not. They're just going to give the keys back. I mean, this is going to be a huge problem. Morgan Stanley analysts reiterate a call for overall commercial property prices to drop 27.4% peak to trough through the end of 2024. Through the end of next year, 27%. So when people say, hey, John, you're selling fear on commercial real estate or the housing market, look at the numbers. Just look at the numbers. I mean, look at where mortgage rates are right now. And this is not taken into consideration that rates are going to continue to rise because Jerome Powell just hiked rates. So if you have let's say, bad credit, 620, you're looking at 8.7% on a 30-year fix. Anything below that has no data available, right? Perfect credit, you're still 7.1%. This is going to be an issue because I think that where we're going to start seeing rates, even for good credit, 700 in that range, probably going to go somewhere around 8.5% to 9%. But that's not a bad situation if you're a home buyer, because what you should care about most is the actual purchase price. You want to get a really, really, really good price. And then if a year, 2 years, 3 years, something happens and you can refinance, great. But you want to get a great price. You want to enter. The money's made on the entry of the deal. You want to enter at the right price, not enter at the best rate. Look at this. News tightens on consumer credit. Auto loan rejections hit record high. High interest rates take a toll on America's finances, right? As APRs reach record highs, what's a good credit card interest rate? Now, people are talking, APRs nearly 21%. The Great Financial Crisis, it was 18.1%. 2008, 18.1%. And that was the average, right? So now if you look at, most statements, it's 28, 29%. That's where most cards are. It's shocking. So look at this. Let's say, for example, you have a $15,000 credit card balance, $15,000 balance, and you have a interest rate of 28%, and you're paying $375 a month, right? $375 a month. You're basically paying $29,000 on interest over, call it a decade, right? 9 years and 10 months. Now, with today's Fed hike meeting, let's say that now that rate goes up to 29%. It goes from the interest rate of 29,000 to 38,000. So basically almost a $9,000 hike in just interest payments alone just by this hike that just happened today. So if you're making the minimum payments, stop. Don't do that. There's a lot of these cards right here. Annual fee, $0. Annual fee is $0. This is 0% interest for 21 months. 21 months. You need a credit score though of 700. 700 plus. So if you have these high interest rate cards and you're sitting on these balances and you're just making these small payments, it's the worst thing you could possibly do. You want to get out of that situation. Look at these balance transfer offers. Start positioning yourself, because these banks, when they start suffering massive losses, what are they going to do? They're going to start cutting credit. That's what they're going to do. They're going to start really pulling a lot of risk off the table. They're going to start really terminating all these offers, I believe, the next year or so. So you want to position yourself now. Because if you have, let's say, a $10,000 balance, and you're like, okay, a $10,000 balance or $15,000 balance, I'm going to pay, instead of $375 a month, I'm going to pay $600 a month. I'm going to pay you $600 a month over the 21 months. Before you know it, you're basically debt-free. Debt-free, didn't cost you a single penny in interest, right? I mean, this is what people should be doing. Looking at these 0% APR balance transfer offers, being extremely responsible. I'm not saying go apply for a bunch of credit and start running into debt. I'm not saying that at all. What I'm saying is, if you can go from paying 20% or 30% interest on a card to zero, that makes more sense. So pay very, very close attention to this. Look at what's actually going on. This is absolutely shocking. I believe we're going to witness another rate hike coming very, very soon. And I think that we're going to start seeing so many situations unfold. This is the time you want to have great credit. You want to position yourself with some cash. You want to have a really good business. You want to put yourself in a really responsible place so you can pivot and move. A lot of people are going to be extremely leveraged walking into the next couple of years. And the place that you want to be is, you want to be mobile. You want to be able to move, pivot. You want to be able to take advantage of distressed opportunities. The real money is made when the masses are afraid. And I think that time's coming very, very soon. What do you think about this entire situation? Drop below, hit the like button, add me on IG. And if you want to fix your credit, we'd love to give you a free consultation at my company, greatcreditfast.com. That's greatcreditfast.com. Catch you guys in the next video.